I don't believe in the whole stagflation narrative. Gas prices as a percent of income today are somewhere around 1% to 2%. So they're no longer your 7, 8, 10% of the past, but it is psychological and that's important. So we're tracking so many things like TSA throughput, and that's actually hitting record highs. You're seeing open table reservations. That's consistent. You're seeing consumers continue to spend at a fairly stable pace. Ultimately, when we always step back on the macro side, we say, what is the biggest asset of the consumer? What's the biggest liability of the consumer? And that always points to housing.
Today's episode is brought to you by Pictet Asset Management and their AI-enhanced ETF range, tickers PQNT and PQUS. You'll hear more about how they're using AI to enhance equity exposure later in the show. For now, let's get into it. Hello and welcome to the OPM podcast. I am joined today by Sean Emory, founder and CIO of Avery and Co. Sean, thank you so much for joining me today.
Max, I'm happy to be here.
All right. So it's your first time on the podcast. I want to just give you an opportunity to introduce yourself, describe the style of investing you do at Avory.
Cool. Yeah. Would love to share it. So, Avory, we're hitting our 10th anniversary this year. So, it's kind of been some time. I founded it with my partner, and really our focus is, building these, data-driven, high conviction portfolios. We have various strategies, and many of them have some commonalities across them, which is, let's find companies that are directionally accurate, meaning where the world is going. Our slogan is investing forward, but we're looking for directionally where things are going in the world. That is a big margin of safety when it comes to investing. Being on the right side of history. From there, it's now you're starting to do some of the legwork, which is really the bottoms up fundamental work that I think traditional fundamental investors have done historically. You see Warren Buffett and some of the other books behind me. There's a lot of that philosophy inside of Avory, but also I think a new school approach, which is maybe more a little bit more tech focused, a little bit more consumer tech focused as well. We run high conviction strategies, so everything from like a 14 stock portfolio to as high as we've never hit 30 names, but low 20s. GARPI is a good way to frame us, I would say, but ultimately a growth oriented portfolio with some valuation discipline in there, and really taking a fundamental approach to how we do our work.
I see the value investors behind you. You see those sort of hallmarks of value, but also if you go to your Twitter account, there's a lot of discussion of macro and what's happening in the world more broadly. Certainly what's driving the markets right now. I would love to get your perspective on how people who are long-term focused tech investors should be thinking about times like this when macro and not corporate fundamentals really seem to be driving the price action.
It's so right. How many charts are out there where you're seeing, earnings expectations, free cash flow expectations rising, and stock prices going the other way? It's the alligator, kind of charts that you see out there. And look, I spend a lot of time on macro because it's less infused in our portfolios, meaning it doesn't necessarily drive decision making per se. But it is a focal point. I think first our investors want to know our perspective on things. So we definitely have a good feel for what's happening on the macro side. And our view on the macro today is there's obviously a lot of cross currents. If you entered the year, our view was you probably want to start moving down in cap, right? We saw the mega caps, and again, this is like pointing to my annual letter, so this isn't me saying it now and kind of go in retrospect. But it's, pointing to our annual letter, it was, we had a year where there was very few names that outperformed last year. It was a very concentrated market. And if you actually looked at, valuation gaps between, some of the smaller names, small and mid caps versus some of its larger cap peers, there was this massive dislocation that was taking place going back all the way to, 20 years ago. And you never know the when in anything in investing. You can kind of like create frameworks and then work off that. And you had a moment where heading into the year, you had the tax refunds. Today we're tracking, somewhere between 10 and 15% above last year. And that was supposed to be a tailwind for the year amongst some of the other tax, incentives that were happening. Fast forward to, month 3, month 4, what do we have? Now we have a totally different situation to some degree. Thank goodness we have the tax refunds, because that's going to offset some of the oil impacts that are happening here short term. Turning to oil, obviously the war was something that wasn't necessarily on our bingo card, but it was something possible. But again, not high probability wise, and that's led to energy prices rising. That has led to people questioning the economy because of the feedback loop to some of this inflationary pressure. So everyone's sitting in this kind of like stagflationary lens today, and our view stepping back is you kind of have these two neutralizing factors. You have tax refunds plus gas prices. Gas prices as a percent of income today are somewhere around 1 to 2%. So they're no longer your 7, 8, 10% of the past. Call it 1980s, 1980s, 1970s, but more so kind of in your very very low single digits. So less important to the consumer. It's more psychological than it is wallet wise. But it is psychological, and that's important. So we're tracking so many things like TSA throughput, and that's actually hitting record highs. You're seeing open table reservations. That's consistent. And again, that is all the way mapping to this week. You're seeing consumers continue to spend at a fairly stable pace. Ultimately, when we always step back on the macro side, we say, what is the biggest asset of the consumer? What's the biggest liability of the consumer? And that always points to housing. And housing is rather stable. Prices continue to tick up slightly. Rentals are coming down. So I don't believe in the whole stagflation narrative. I actually don't think those two things can align. I think inflation is actually a lagged indicator, and therefore we're just looking at one indicator that's lagged and one indicator that's now. And anyways, my view there is tech. Some of these more growth oriented assets are longer duration. You should be able to look through the noise here short term. If you look at like 5-year break evens, those are actually going down. So the expectation for inflation is actually lower, not higher over the next 5 years, at least from the market, and that can change overnight. We all know that. But that's how kind of we're reading the room, which is we think the consumer's in fine shape. The jobs market is just okay, right? We're adding jobs. We're kind of seeing attrition be kind of like the job, not destroyer. You have AI, which I think is a productivity tool. I still think it's early in the AI kind of realm. So I'll stop there because I've been, chatting a lot, but that's kind of our views from a little bit more detailed in some areas and a little high level on some others.
Yeah, I think that consumer strength is something that has really surprised people. Certainly, there was discussion of the consumer being tapped out even before we had this oil price shock. And then we got consumer spending numbers that came out recently, and they were incredibly strong. We had strong manufacturing numbers, another thing that I think people were very surprised about. So when you're looking at these macro factors, but then also looking at them at the individual company level, where are you seeing that strength show up at maybe some of your portfolio companies?
So some of that macro data that I'm referring to, whether it's obviously, full disclosure, we own, this company, someone like Clear Secure. It's not a recommendation, but, Clear Secure is one where that's benefiting from some of this travel. Clear is in the airports, right? So it's an identity platform. We view it as an identity platform, not necessarily as a pure, airport business per se as they move into the enterprise. But, more importantly to the macro trends that you're seeing is the consumer continues to spend, they continue to travel, whether it's domestic or international. So that's important, right? Number one. You're also looking at a company, somewhat like, a First Watch, which again is a company we own. It's a restaurant category. It's one of the fastest growing ones. Obviously, there's pressure on the name from a valuation perspective. A lot of that makes a lot of sense to me. If people are concerned about the consumer on a go forward basis, you're going to pressure some of these more consumer oriented assets. But ultimately, they're doing well, right? They're comping positive in an environment that people are concerned about. That high net income or income household is performing a little bit better. People talk about the K-shaped economy, and First Watch skews a little bit more affluent than some of the other restaurants out there. If you step back and you look at some of the other just broad areas, you're hearing from the airlines, you're hearing from, again, more broad retailers that are out there. And it's a little bit hit or miss in some of those, and I think most of that is actually just trend oriented. You have someone like Chipotle that's struggling or seemingly struggling, and I don't think it's necessarily a consumer issue. I think it's they raised prices too much over the last 3 to 4 years, and they've kind of peaked out on that, and therefore they have to drive traffic as opposed to raise price, and that's impacting them. But I think that's more company specific than it is anything else, because you're seeing Dutch Bros versus Starbucks, right? Have their own little battle. You have like Lululemon versus On Holdings have their own little battle where On's performing incredibly well, but Lulu's struggling. I think people will isolate the negatives and bake that to the consumer or the macro. When in theory, I think it's just more of in some of those cases oversaturation of the brand, and therefore you kind of have to give back to get more in some of those use cases.
Look, you talked about the K-shaped economy. It's something that we hear a lot about. How important is that when you're thinking about getting exposure to this strong consumer? Are you really focusing on that top half of the K? And you know, certainly it's a trend that's been going on now. Whether you the K-shaped economy language is new, but we've been talking about growing inequality in the US economy for a long time now. The question being, when does it break down? Do you see any end in sight to the widening of the K?
It's a good point because there's some different thoughts out there around like AI, right? And who one, it costs money to run AI, so you kind of have to have the more money you have, the more compute you can use, the more resources you can use, and that may be company specific, but that also filters down a little bit. Also, like the the idea that tax refunds and some of those things where specifically this tax refund season, some of it is from that big beautiful bill, and some of it has to do with building and front running some of your capex spend, which again comes from large organizations likely than smaller organizations. And so I don't like, we obviously track the idea that there's has been this splitting of the consumer. And the funny part, though, is part of it, I think, is just normalization from several years ago, where actually coming out of COVID, there was this view that the low end consumer was going to get hit, but actually they were the ones getting all the tax refunds, or not tax refunds, but PPI and some of those other checks that were coming in the
The
mail for
$3,000 check had a greater impact on them than it did the high end consumer.
exactly, yeah. So you kind of had the opposite of the effect happening then. And then obviously prices of goods and services went up, and then the normalization of that high end consumer relative to the low end. So I think some of this is just time series analysis and just like it's more normalization, and we're still working off some of these kinks. So I do think net there's some forces at play like AI and that that can impact that K-shaped economy a little bit, but I think that's at the corporate side. When you think of the consumer element, I do think it's a function of normalizing post COVID, and we're still normalizing to some extent. So I think consumer element wise, we actually may see these things normalized, and converge as we push forward, as opposed to the opposite. I also think in the world of AI, I was at a fair the other day, and I'm looking around and seeing job functions, and I'm like, most of these jobs are not going to get hit by AI per se. Someone has to check in someone at the Ferris wheel, and that individual is necessarily not in the front lines of what AI is coming after. And so there could be this actual moment where your, call it, lower income worker, let's say, depending on function, is actually a little bit more immune to some of this, because if you have someone that you're paying $500,000 to software develop, and you can replicate that in different ways, I think that person may actually get hit. So you may have a convergence over time. It's messy, and I think that's the biggest takeaway, though.
Yeah, it's funny. A lot of people talk about AI and how it's going to hit jobs as it relates to employment. Um, but to me, the big thing is like 401k flows. Like it's the white collar work where that relentless passive buying has come from. How are you thinking about the potential, as you said, for this to hit white collar harder than it hits blue collar? And everyone will be focused on unemployment, but there's a big flow component that comes from these white collar jobs.
Definitely the last, I mean, what, 10 years, you've kind of had this continued push, one from asset managers moving into kind of these retirement ecosystems, and then two, just the idea that one of the best ways to keep employees is to have them in these plans where they can see kind of assets growing and kind of having them feel as if they're part of the company in many ways, even though again that's not necessarily directly tied to the company, and it's more tied to a retirement account. But you know in general, like, if you do have any sort of meaningful attrition, a real shock, that happens all at once, that would impact obviously and have a circular effect on markets. I would think in terms of those passive flows. I'm not in the camp that we're going to see a sudden shock and one day we wake up and all of a sudden a million people are out of jobs. And I say that because we obviously run our own business and we're using a lot of AI internally. And what you tend to find, in general, is actually that the more AI you use, the more things you're doing and serving, and you actually have to start thinking about like a point person for that. And you're kind of have like you're hiring like point guards, like some say product managers, but like point guards in basketball terms to really run the show. And you may have a single marketing person. So think of like you may have these large organizations that have many people, tens of thousands of people. And what you're seeing there, at least today, is they're adding sales headcount for the most part. We're tracking like Indeed job openings. They're actually adding software developers, which is interesting. And why are they doing that? And it's not necessarily from the software companies, but when you step back and you think about who are the companies in the world, most of them aren't tech companies. That's the reality. Market cap wise, they are, but like nominal terms of like sheer count of companies, most of them are not. 90% are not. They're in landscaping and this and that. And some of these companies, or many of these companies, they want to use AI, but they have no internal acumen for it. They don't have any software developers on staff. They have nobody that knows tech at all. And so they have to start hiring people to understand this stuff. They can go to a consultant, but then, if they're overwhelming consulting firms, then who's hiring? The consulting firm has to hire to deploy people into these organizations. So, I step back, and again, there's so many angles you can start to pull and tug at. But the reality is I do think, and I always go to the quote, is the more things, change, the more they stay the same. And ultimately, I think we're going to be doing similar things in different ways. And there's a lot of acumen that is required to do these things. And we use it internally, and you need a point person. Like we're in the process of looking at somebody to help oversee some of our stuff. As opposed to, me in there every day, or, my partner in there every day, or, someone else on the team, in there every day trying to figure it out. And it's really allowing more work to happen more productively, but that requires more people actually. And you hear Aaron Levy from Box, he has a good view on it as well. And I agree, which is simply that, if your sales reps are, 10x more productive, and your software engineers are 10x more productive, meaning maybe they're doing 90% less work to have the same output, you're going to hire more of those because productivity is everything, right? So I would have 20 of them doing 100x work versus 10 of them doing, 50x work. And so that's kind of how I think it's all going to manifest into, but it won't be straight lines. You'll have moments and times where you're questioning probably that thesis. But I think that's our thesis for now.
As soon as AI tools began to wow the world, investors started asking, when will AI-driven strategies become more common? The answer is they already are. Sophisticated quant hedge funds have been using machine learning strategies for many years, largely only for the benefit of institutional investors paying higher fees. Now, with the barriers to usage coming down, AI and machine learning approaches are being democratized and made available to you through Pictet's AI-enhanced ETF suite, including the Pictet AI-enhanced International Equity ETF, PQNT, and the Pictet AI-enhanced US Equity ETF, PQUS. PQNT seeks to deliver enhanced international equity exposure, while PQUS seeks to provide US equity exposure, both aiming to uncover potential sources of outperformance that may be difficult for human investors to detect or explain. And unlike many other active ETFs, they aren't just taking factor risk, leaving you overexposed to specific sectors and betas or style exposures. Instead, they help neutralize factor exposure to minimize index tracking error. That means if they outperform, it's coming from true idiosyncratic stock returns, not excessive risk or factor exposure. To learn more about how you can harness the power of AI in your portfolio, check out the link in the description. Investing involves risks, including the possible loss of principal. Because these ETFs rely on an AI-driven model, the strategy may not perform as intended. International and US investments may involve additional risks such as currency, political, or regulatory developments. Instead, investors should carefully consider the investment objectives, risk charges, and expenses of the fund before investing. The prospectus contains this and other important information and may be obtained by visiting pictet.com/ETF. Read it carefully before investing. Distributed by Foresight Fund Services. How are you using AI internally? Is it more on the ops side or the investment research side? It's been a big debate as to how it's going to affect the investment management industry. Is the junior analyst going the way of the dodo?
I don't think so. I made a post the other day, which was I always try to go. So I use a lot of the AI tools. So I have everything from Perplexity Computer to Claude Code. I dabble with Cowork, but I'm more on Perplexity Computer right now. We use ChatGPT and Gemini as well. We use Replit for some of our internal uh, you know dashboard capabilities for some of the investment oversight. Um, and a lot of that, where our goal on the AI side is be very hands-on manual, um, and then have consistent oversight, like a wrapper around yourself that is AI enabled. So you can you go and build a thesis, you go and build an analysis on a company or whatever, and you overlay it with AI tools that are again, and the way we have it built is a single click allows us to oversee what we're doing and essentially point us in a direction that is maybe differentiated from what we're actually thinking and what we're doing, and then we can start to co-pilot and work together with this kind of like AI tool. But it's all infused, so everything's embedded in one system. We built that in house. Obviously, we vibe coded some of this stuff. We also brought in someone else from the outside that could scan some of the back end just to make sure things were you know standing up properly, let's say, and would be able to be sustainable over time. So that's kind of like some of the stuff we're using. So everything from I would say investment oversight. Number one, you have kind of like some of marketing and operational side, but less so like compliance and all those things. We have an outside and internal, compliance, and we're not necessarily using AI for that per se. That's more hands-on for sure. So again, we kind of have this hybrid approach where it's everyone says human in the loop, but I think it's human first, and then the loop is AI, as opposed to the opposite where it's AI and then you're kind of just getting the regurgitated view. And the reason for that, and I didn't finish my statement on the post the other day on junior analyst, which is, every so often I put the same five, little prompts into, Claude or some of these others and ask virtually the same question in a different way. It's really just trying to extract numbers on companies to see if like, where are we in that process of actually using it as a true analytical tool with, 99.9% accuracy. And today that it's still very much not there, but it built me a bunch of stuff the other day and quickly, I knew what I was analyzing, right? And I've seen the numbers and it was producing everything that was completely different. And then I asked it, did you make up these numbers? And it was like, yeah, I did. And my prompt was clearly not to make up numbers, and it still made up numbers. And that is something that a junior analyst may or may not do, but making up numbers, I don't think a junior analyst would attempt, especially when these numbers are, in filings. You can find them in, things like Fiscal AI or something like that. So anyways, my point there is we're still ways away from, I think, and again, this is our industry specific, where you can't have inaccurate numbers. And if you are, your analysis is totally blown out. 10% difference in your growth rate over a 5-year window just totally changes your numbers. And so there's a lot of sensitivity to the multiple, to the growth rates, to the actual starting revenue or margin line that you're using. And so I still think we're a little bit away, but over time, I think that job, that junior analyst, will be more of a somebody that does many things as opposed to a singular thing, which is historically what a junior analyst would do.
So what do you think it can do right now? Well, we talked about what it can't really do. Is it maybe taking, I think a lot of PMs have talked about, you ask an analyst to go give you a write up on a company, and you get a book report back, right? When what you really want is a one pager. Is it maybe helping the junior analyst communicate better with the PM, helping ideation move faster? The analysis is still being done by a human being, but the communication process, the visualization of some of the factors is going to be clearer and better with these people who, they, as much as PDFs and PowerPoints are a huge part of the job, it's not what every junior analyst goes to school for and what they imagine when they think about their hedge fund analyst job.
Human first oversight with AI is my best use case, because what the output conceptually should be, and then you can infuse AI around that to then produce things faster. And so it does really well at text, right? Text only. And not text when it's doing web searches, right? So you've already, articulated whether it's through dictation or something else, and you're trying to clean up, right? I think the refinement using AI is like one of the most powerful things, right? The speed to that is incredible. Going from voice to text to then refinement is like the best, right? And there's little room for error in that, right? Because it's coming from your mouth, you're putting it in there, and then you're streaming it out. So maybe you've gone out, you have a thesis on a company, and then you're going out and saying, into some of these AI tools, and articulating for it to summarize, synthesize, and then also have like a rebuttal to you. And then I think it acts as, again, like almost like an investment co-pilot for everybody involved. So text, it does well. I think, again, like you said, visuals, again, as long as you know what the input is and the output should be, or like idea, that's really where it shines. So we're using a lot in those ways: refinement, visualizations, and then also I think ideation, not only for investments but in general. Look, we're seeing a massive rise in apps being deployed in the app store. We're seeing a massive inflection point in business formations. They're up 20 to 30%. So you're seeing a lot of ideation, not only in investment world but also outside. In the investment world, I do think it does serve a really good purpose, where you're saying, hey, you know what, war's breaking out. um, Inflation may or may not, let's say we assign a 50% probability of inflation rising above X percent over the next year. Please review my portfolio and tell me if there's any sort of, things, or, how should I transition this portfolio to navigate that? And again, you want to set your guardrails around that. But it does provide insights, I would say, that is ideation involved or infused across the board. And the negative to that, I do think, is most people end up in the same spot. It's almost like very similar to what you were referring to before, which is like these 401ks where people are just blindly buying things in their 401ks because they're in a SPY ETF or like some sort of whatever fund. They don't really know what's in it. They don't really care. It's passive, and it's long term. And I think that is likely happening also in the investment world, where everyone's saying, what's the best AI plays? It goes out and reads, a bunch of articles, and it comes back with the same five, and everyone's, then investing in the same five. And it's a gift and a curse, because if you're riding the wave, it feels great. But at the same time, if you're seeing that and you're more concerned about valuation and like, when does this AI cliff start to peak out, then, maybe you're less involved in that trade. And the keyword there is trade in many of those instances. So, there's a lot of moving parts in this stuff, but I do think it's a very powerful tool.
Yeah, it's interesting. I mean, holding periods have been coming down even before AI. As you said, it's easy to put in a prompt and say, there's this new trend in the market. How do I get exposure to that? Do you see more of this high portfolio turnover coming out of this AI investing trend?
Oh, 100%. I think what the NBER study with another group, they articulated the average time spent on an investment on those surveyed was 6 minutes. Um, and then what they consider to be more professional oriented investors or traders, however you want to frame this, was 30 minutes, of which 14 minutes of that was spent on looking at the price charts. I believe like 10% was focused on analyst expectations. And then there was like this small portion on, what the company does, and all these other factors. And I think that's the world we're living in, unfortunately, as someone that is, definitely, trying to and continuing down the path of, long-term investing, thinking through these ideas. Again, we make changes when we think, there's permanent loss of capital risk, and those happen at, sudden, moments in time. And so you're trying to navigate that. But yeah, the compression of time spent to analyze these things, research these things, I think is also then a feedback loop of time horizon. Because if you're only looking at price charts and you're only looking at analyst expectations, the reality is those things change on a dime. Price chart or price targets follow price generally. If you look at that, they follow it up and they follow it down. and then you're following the price of the chart. So pretty much majority of your analysis is directionally sensitive to price, and what has happened in price versus what what could happen. And I think that's the gap, slightly, in the ecosystem. So yeah, I think time invested is compressing. Um, and it's kind of sad, to be quite frank, because it's supposed to be a mechanism to find these companies that you believe in, that you're following these stories, and talking to management teams, and that's just changing in aggregate on the edges, and becoming more of a trader environment. But I think, again, if you step back, I think net, if you go fast forward 10 years from now, I do think the companies that come out of it on the asset management side are definitely going to be long-term oriented firms that infuse AI in their process, not necessarily the process, and ones that are more concentrated than more diversified, let's say, and spraying and praying. That's what the index is for, and if people want to do that, they can do that. It's a great option for a lot of people, but that's kind of how I see the ecosystem.
You talked about how you are seeing actually hiring come out of this AI trend, but I'm looking at some of the holdings here, and I see Block as a top holding, kind of like most famous for doing this big AI layoff. So I got to ask you about that contradiction, and why you like Block so much.
And I love Block. We invest in it, so full disclosure there. But
Yeah.
yeah, I mean, look, they are. There's some nuances to the Block thing, right? They obviously acquired Afterpay, 5 years ago. That was kind of its own team. Nick Molnar, founded that, led that. He still, helps lead. Then you had Square, which was kind of its own independent firm, and then like 8 years ago, Cash App was really starting to build itself. You have Tidal in there, which they own. They have Proto Mining, which is their Bitcoin mining, division. And they have, two or three other things that are kind of like inside the business, maybe not staffed all that well, but when you step back and you think of that, there's multiple layers, multiple companies, siloed businesses, and they essentially wanted to flatten their business. We kind of saw this from the mega caps in 2022, 2023, flatten the org structure, get back to kind of this, at some point you get too big. And if you're kind of like a visionary focused organization, like I think Jack Dorsey is, I do think having a flatter, smaller organization is ultimately is what they're trying to deliver there, as opposed to solely focused on, hey, let's do this because of AI. Let's do this now because we want to be flatter. AI is a big trend, so let's all get closer to the product. Let's all work together for our future and build an ecosystem that's more collaborative. And so I was at their investor day in San Francisco, got to hang out with some of the execs there, and I got to see their Goose product, which is their AI product in motion. And it's what you would think. It's kind of like a co-pilot in the mornings, whether it's for their developers or for their product managers. And ultimately, you can't have I mean, you can in theory, but you rather have one stack that's overseeing the entire organization and everything working together with one data silo, as opposed to four or five. So I think it's all those things combined, trying to be much more forward thinking and visionary, flatten the org, and then infusing AI to help the company internally collaborate. So a lot of those things. Now why we like it, outside of just that dynamic, is there's a renewed focus there. This is our second time investing in them. We invested in them pre-COVID, right at the start of Avery, really in 2016. We sold that, in that COVID timeframe where everything was just up and to the right, did well, and then it came crashing down, and we were able to pick it up again. And over the last several years, what you've seen is, again, a refocus on the business from the standpoint of, let's get these ecosystems to be a little bit more tied into each other. Let's flatten the organization. Let's increase our product velocity. So you're seeing that at Cash App here. They built a go-to-market for their Square business, which Nick Molnar had at Afterpay, which is paying dividends. So what you're seeing is 4 straight quarters of acceleration for all three businesses. And ultimately, we think it's all coming together at the same time where you're seeing operating leverage. And then, they're building a war chest of cash here. And so, you get those things combined, and then you have a multiple that is, low teens, growing and accelerating here, I think is pretty attractive. Inflationary, that actually hits point of sale providers in a positive light, right? Because the cost of things go up, and all those flow through their platforms. So look, I think they're doing a good job. AI is going to be a helper to them from the product side because they have so much data around their Square sellers. And so some of the products that they're announcing, whether it's on Cash App with their Money Bot and some of their Builder Bots stuff, I think are all super interesting. So cheap asset, refocused and recharged, and also products that are accelerating here. So many of the things we look for.
Okay, now what about Zoom? Because that's one that people have been giving an AI premium to because of the stake that they own in Anthropic. Is that how you're viewing it as a proxy for ownership of Anthropic? Or are there other things that people are missing?
No, that's more of a nice to have. Honestly, I'm happy it's there. They've been it's a function of how much cash they've been sitting on, right? So they have $8 billion of cash, no debt. Eric Wan, the CEO founder, and again we invest in them. Just full disclosure again is they they've been consistently prudent with cash, and obviously as someone that is fundamentals first, kind of that Buffett mindset in a new world is certainly attractive from a balance sheet perspective. When they went public, actually, they had I think like $700 million of cash, no debt, and they still raised $500 million or $1 billion, right? And he always says, you raise money when you can, not when you need it. And here's a company that's spitting out $2 billion a year in free cash flow, roughly. And our thesis there was everyone was questioning, why didn't you own Zoom during COVID, as it was continuing to go up? And we're like, look, it's a meeting product. This thing could be replicated, in theory, at some point over the next decade by many of the larger, cloud peers. And you saw Amazon go after it with Amazon Chime. You saw Meta go after it with the Amazon or Meta Workplace or Facebook Workplace at the time. You obviously had WebEx and some of the smaller, platforms out there like Dialpad. You had obviously the bigger ones. It created a refocus for someone like Microsoft to really think about their Teams product. You have Google with Google Meet. And ultimately, our view was, that is risk at the time. You were paying like 120 times sales back during COVID for this asset. Mind you, it was growing 350%. So I get kind of like the idea there. But if you're truly thinking long term and not a moment in time, you're thinking about the product durability as opposed to the current momentum in revenue because everyone needs it because everyone's locked down. And then fast forward, a couple of years after that, obviously valuations compressed meaningfully. But more importantly for us was their product platform started to emerge. So we have writings going back to 2020, 2021, 2022. And it was kind of like, what do we need to see to invest in Zoom? Because we actually like it. I like Eric Wan. I like the product. It's best in class. And we needed to see valuation compress meaningfully, and we also needed to see a platform emerge. And you saw them launch Zoom Phone, which is over 10% of their revenue today. It's the number one fastest cloud phone business out there in the world, and they've overtaken some of the legacy players. Most companies are attached still to wires inside of their organizations, and so there is this mega trend over the next decade that phones are going to go more from this legacy PBX all the way to some of this more cloud native, and Zoom's positioned well there. Then they have Zoom Contact Center, which is their contact center business, which is great for AI because customer agents need kind of infused AI inside of them. So when you go on someone's website, you hit a chat bot, it goes, these chatbots are pretty smart these days, and they know all the context of the organizations. That feeds back to their sales or support team. All of that is built on top of the Zoom stack. So the contact center then sends it there. You have Team Chat, which is a replacement for someone like Slack. We use all these products natively within our company. So we're seeing the product in motion. And so they've gone from a single product to a platform company, all trading at a valuation that's somewhere around, again, low teens, free cash flow multiples. Growth is accelerating. This isn't a fast grower. We just think this is a consistent compounder for a while that deserves a much more premium multiple to it. And then they have $8 billion of cash. And then the nice to have, like you mentioned, they invested $53 million in Anthropic, 2 years ago, and that position is now worth somewhere around, $2 and change billion. And they're likely going public this year, so that'll increase, that value. And if you take that, that's roughly, 15 to 20% of the enterprise value of that business today, add on the 40% is roughly cash. And then you have a business that's actually accelerating from very low single digits to mid single digits that we think in the next couple of years could have an exit rate at some point, closer to a double digit level. And then we'll see what they do with capital allocation. But there's a lot of things they can do.
What is the customer profile like at Zoom? When it first hit the scene, I think everybody was kind of experimenting with it. The as you said, Google Meet wasn't quite where it needed to be. Teams wasn't quite where it needed to be. But a lot of larger organizations are plugged into Microsoft or Google Workspace in some way. What does an organization that's on a Zoom platform look like?
So about a third of their business, roughly 40% or so, is what they would consider enterprise businesses. These are companies that sales reps touch. And that's 100,000 payers is roughly 40%. 60% is enterprise businesses. And again, those are companies that sales reps touch. So more of a hands-on experience. So you have, the way we think about it is twofold. Number one is you have many of the companies that don't want to sit inside of the Google's or Microsoft ecosystems. Think of Intuit. Amazon's a customer of Zoom. Two of the, I think, Fortune 10 financial institutions are customers of Zoom. These are all institutions companies that compete against Microsoft, compete against Google. And conceptually, that makes sense to me. You want to be an independent provider that is safeguarding your information, your sales reps, everything. I mean, not to say that Microsoft and Google are listening to these calls, but if I was running a business, I'd probably want to be on an independent provider than my competitors, and inside of their cloud. So there's some element to that where I think you get these independent providers. We track the Okta business survey that comes out every year. Okta is a pretty good reflection of like which companies, enterprise companies, because that's really where Okta positions itself. Which enterprise companies, what are they using, what tools and applications, because Okta is the gateway into your app ecosystem. And so they have really good visibility of who's using what, cross usage as well. And what we've seen is over the last 6 years, Zoom continues to actually win inside of Office 365 accounts, which is very counterintuitive to what the narrative was or has been. I think people are starting to stabilize on the idea that Zoom is stable and established. And so Teams has done a pretty good job at obviously bundling their ecosystem. Google has done an okay job at doing that. You could argue they would want to do more there over time. But ultimately, the other side of the market, which was like the WebExes of the world and the Dialpads of the world, the independent providers per se, where you're not full stack cloud to productivity and communication, that's where Zoom wins. And then they win a lot with kind of like your free user that is trying to use something for 40 minutes. And they're trying to have some initiatives there to get your serial 40-minute adopters to some sort of paid plan. So I would say that's how we kind of think about their user base. But again, a third of their 33% of their users are paying $100,000 or more in annual spend, and that's growing roughly 9 to 10%. So that's actually their fastest growing segment today.
You said you wanted to move down in market cap. Block, Zoom, they're not small companies by any means. So I think it might help make sense to discuss a little bit more like what is a smaller company to you versus some of the larger companies in your portfolio.
Well, anything relative to a couple $1 trillion is fairly small these days. So we definitely categorize small mid somewhere between like obviously sub 750 million market cap all the way up to I would say mid caps are somewhere in that like 15 billion today. It's like mid cappy, right? As everything continues, like the higher it starts to get higher, there's a K-shaped, clearly a market structure as well here, where the big providers are huge. So yeah, that's kind of how it frames sizing, and we have different companies in there. You have like Omnicell with medication management, which is somewhere around a couple $1 billion. You have the Clear Secure, which is somewhere around $6 billion. Zooms and Block's bigger, right? In the mid 20s, high 20s, low 30s, depending on the time you're listening. And you have like Zillow, which is somewhere in the teens, right? Of billions. First Watch again, which is low end of billion, so like $2 billion, $1 billion in terms of enterprise value. And so those are some of the areas that we think are interesting. One of our companies, Mr. Car Wash, just got acquired. That was a smaller, multi-billion-dollar company. So again, that's like the structure or area that we think is fairly interesting. It's one, many of those didn't get a lot of the lift in as it relates to this passive investment flow that's kind of been the narrative over the last 3 years. I think over the last 3 years, if you looked at the numbers, the average percent of the index that was actually beating the index was like sub 25% for the last 3 years. So there's a very small group that was outperforming. And that just speaks to a lot of potential opportunity in the everything else bucket. And so then you want to pick and choose. And obviously, in a world where there's war and inflation, something that's consumer oriented may not do so well in that moment in time. But again, I would say that's the segment and some of the names that are interesting. Omnicell, for example, is hitting a 10-year refresh cycle here. They sell these like medication robot cabinets inside the hospitals. Kind of like a boring but stable, but in some ways sexy business, depending on how you look at it. These medication adherence platforms inside of organizations, it's a duopoly. It's them and Pictet, which is owned by Becton Dickinson. And I'll be brief here, but they have kind of these refresh cycles of their cabinets, and they happen roughly every 10 years. It's almost like an iPhone cycle. And so we're at the leading edge of their next 10-year cycle here. And so they'll start to get their bookings in, probably mid to late this year. And then next year, that'll start to manifest into revenue. And again, it's kind of like Apple meets Boeing and Airbus, meaning these huge capital cycles. And so they're well positioned in that lens. If you're just stepping away and trying to get out of the noise of like what's happening in the world, that doesn't mean it won't be volatile. But at the same time, I think it's an important, interesting time for a smaller name that punches above their weight relative to their industry, meaning their size. That I think market cap doesn't reflect how powerful they are in the industry. And ultimately, that's what we want to find is like who's small but powerful in their industry and has those same like competitive dynamics or economic moats that maybe the incumbents, like the large, trillion-dollar companies have, but at smaller scale and better valuations.
So a company like that, you said it's got a 10-year cycle. There's like a 10-year capital cycle. That's something that Wall Street tends to hate, right? They don't like business. They want nice, steady monthly revenues that are coming in. Do you find that those are opportunities for you, for people who are longer term, when you find a business that the earnings are predictable, just not on the time scale that Wall Street likes?
Right. Yeah. Yeah. So if you take like a 5-year rolling average, you get pretty straight lines. Um, I mean, look, clearly people love NVIDIA, and that's kind of a similar-ish story, but probably shorter cycles.
Well, not right now.
Um,
Not right now. People are projecting that it's going to be like this forever.
there's definitely a time and place where people like these things or don't like these things. The look, they're trying to do a couple different things. They have a software reoccurring part of their business where they have consumables inside of these platforms. They have smaller pieces that have to get deployed, every couple of years. So they're definitely trying to flatten out some of that volatility in the revenue. And so I think today, roughly 50 to 60% of their revenue is now considered recurring. And that is the path forward for them, is trying to have these people commit to longer scale cycles. Again, kind of like what the iPhone did with the mobile providers, where now they have kind of more visibility into the pipeline because they can utilize different tools, whether it's leasing, and that becomes much more predictable in terms of revenue and bookings. In addition, what's important here that's different from some of this other stuff, which is they sign these 10-year sole source contracts. So anything medication adherence or management wise has to be bought from them from the buyer to Omnicell for a 10-year period. So they've locked in this sole source agreement, and they have kind of this runway of the product cycle. So you take all those things combined, you kind of get more of an interesting, more sustainable visibility on a go forward basis when you hear some of those things. They're also starting to see more competitive wins again. They went from like 30% of the market to 60% of the market. And so more companies, more hospital systems and acute care facilities are standardizing more and more on Omnicell. And I think it's a function of Omnicell. This is all they do. Pixis is inside of a conglomerate. And, when you're a small fish in a bigger pond in the same organization, sometimes you don't get the same, you know, budget, let's say, or care or flexibility to win deals potentially that, would miss in earnings or not miss in earnings. So
I think this is an interesting one to tie the bottom up. Like, we've been very bottom up on the company now, but you
yeah,
have this top down approach. I mean, is this tied to the graying America, the demographic trends that we've all been hearing about? How does this investment tie back to your top down views?
we have roughly like 12, 15 different areas that we look at. And they don't change all that much. Maybe how we phrase it changes a little bit. But generally speaking, I think someone like Omnicell fits in two main buckets. One is the automation side. So automation is everything from like physical automation to, obviously, now we're seeing much more software automation, which is really around some of your deterministic stuff like RPA, traditional robotic process automation, like UiPath or something, or your more probabilistic, which is some of all the AI stuff that we're talking about. Then you have like robotic automation, which can be everything from obviously robots and someone like, we don't invest in Aurora, but it's trucking and it's automating some of that. That also tiers into some of our mobility conversations that we look at. But Omnicell specific is automation inside the hospital systems. What that means is they have these like XR2 cabinets at the bottom. You pour 33,000 SKUs, it automatically sorts them. It allows the pharmacist to do the job they actually subscribe to do, as opposed to being administrators. And then on the top side, it's automating some of that workflow, which is in these little cabinets. If I'm getting a drug at the right time, and I have to give it to a patient, it'll automate that workflow for me, meaning I put the order in or the nurse puts the order in, and within whatever time frame, they go and pick it up from the cabinet, and it'll isolate that certain drug in that certain area. And that ties back to our other um, um, theme, which is really around the changing dynamics and or reducing the cost of things like healthcare and education, which we think are burdens to the economies and of focus. And we tried to carve out different areas of healthcare. Obviously, there's the health system broadly, and that's not something we're going to try to tackle. But then there's like low hanging fruit, which is medication errors, medication waste, medication theft, and that's ultimately where Omnicell fit in. And we found them based on that premise, which was there's roughly a $300 billion problem that, again, theft, waste, and errors that happen in the system that could be avoided through just having guardrail systems and automations in place that allow you to know who took the drug at the right cabinet, gave it to the right customer or right patient at the right time, understanding how much inventory you have. There were stories during COVID where some of the hospitals in like New York didn't, they had certain drugs that were required that they could have used to help, different individuals or patients. And they didn't know that where they were in the system. And just having a simple robot automation cabinet that has sensors and scanners inside that knows exactly where they are. It understands the barcode. It understands the inventory so that it can replenish that or send a signal for replenishment at any point in time. So that's the bigger theme. It's somewhere between automation and the future of healthcare, which is, reducing the costs and burdens around it.
This is like the smartest smart fridge in the world.
I know, and it works. That's the different from like those Samsung ones.
Yeah, and no ads. And no ads.
No
Uh,
ads.
Well, look, another trend that clearly you're focused on is housing and the housing market. You've got investments in Zillow, Airbnb, Blackstone. Is a broad business, but probably some housing tie in there. I'd love to get your take on the housing market and why you're invested in those three companies.
Airbnb is pretty new, and Blackstone's pretty new. We've owned Blackstone many times, right? But this is another time of owning it. Obviously, some of that has to do simply with the idea that valuations compress pretty dramatically, and kind of your asset management, private equity, private debt, ecosystem that is top of mind today with some of the software stuff. So we think that was more of an opportunity there, opportunistic, there based on valuation and some of the valuation compression that's recently happened. The other two is really around the idea that we think with AI and agentic capabilities and the ability to develop products at a much faster pace, you do have the opportunity to really push into that super app concept that people have been dreaming of for the last decade. But I don't think super app meaning one app that does everything for us, but one app that does everything for us within a vertical. And so you think of something like Airbnb, or you think of something like Zillow, which has done very well. If you look at Zillow today versus call it 5-10 years ago, they used to have virtually one revenue stream, which was lead revenue, lead generation revenue from their agents. And that was ultimately it. They sold leads to agents. These agents would prepay for this lead generation capability, and they would deliver it to them. And there was some volatility in the pace of how they would generate revenue. Since then, they've moved into, they tried the iBuying stuff, but that actually allowed them to build a national mortgage network, which is one of their revenue streams today. So they're one of the fastest growing purchase origination mortgage lenders out there in the country. So they're winning on eyeballs. 2 billion people are visiting that on a quarterly basis, like 220 I believe on a monthly basis. They're like a top 10 internet asset in the world. Yet it's valued at a fraction of some of the other higher quality, most trafficked internet assets out there. I think there's this gap between that can be solved over time. And solving that comes in those different phases, going from number one, that lead generation product, which was kind of one way, to moving into what was called Zillow Flex, which was they work with the top agents in the top cities, let's say, DMAs, and they work with them for providing them full service, full attention, higher quality leads, or all the leads in that area. And then Zillow benefits by, on the back end, by getting anywhere from like 25 to 40% of the money that is the revenue generated from that lead. So they reverse the script there, which is pay to play versus we'll send you the leads, you win, almost like a traditional brokerage model to some degree. But they're picking and choosing their agents and then supplying them. What it does for that agent in that moment in time is it gives them more capital runway. Instead of spending $2 million a month ongoing in perpetuity, hoping leads come in, its lead comes in. Now I can spend that $2 million on new agents or more agents to then go out and drive business. And at the same time, every deal we close, we're paying Zillow. So that's one avenue. They've moved into rentals as well. They're the fastest growing rental platform. There's 75,000 units on that platform today. And so they're continuing to make progress there. They're on their way to $1 billion in revenue for rentals. That's more recurring in nature, right? That kind of thrives in good times and bad times.
Is that just listings from landlords?
Yeah, some of it is like residential, like homes. And then a lot of it comes from your multifamily properties where you have like an apartment building that is using Zillow to drive leads and inbounds. And they're working full end to end from discovery. So going on Zillow, finding the property, to then sending an inquiry about an apartment, to then filling out like background checks through Zillow, all the way to even paying on Zillow. I think they had their investor day here recently. And they've had about $10 billion of payment volume go through their platforms since they've created this product. And I was like, wow, I didn't actually realize how much volume of dollars. Obviously we invest in Square, we look at Toast, we look at all these other payment platforms, and that's a big number for something that you don't think of as like a processor of payments. And so again, the big picture there is that they have multiple line items and verticals of revenue sources today. And then they have Showing Time, which is their touring product that they acquired like 5 years ago. They have Follow Up Boss, which is the number one CRM for agents. And so they're putting all this into a fuller package for agents. They're utilizing AI, which was a big part of their investor day, highlighting how the data that they have internally is much like you can go on ChatGPT and get some stuff in the real estate ecosystem, but it's not going to be as quality in terms of the output. And then the end to end, the visualizations, the visuals that come with it. So I think that's a very important thing. Now, stepping back again from, you talked about housing, and why I think it's important is, look, housing's been flat. We're hovering around, existing home sales that, mimic some periods of like post financial crisis, right around 4 million existing homes sold. We peak around like 6 million. That number goes up a little bit every cycle. And so mortgage rates are elevated. They were coming down, and then obviously you had some of the the war stuff take place, and that sent long rates a little bit higher for sure, and mortgage rates higher. So that dents it a little bit. But if you look last year, the existing home sales were roughly flat. They were coming off the bottom a little bit, and Zillow was able to grow mid-teens and grow earnings faster and expand margins. This year they guided to the same thing, growing mid-teens and to increase their core margins by another 2%. And again, they have a product cadence that I think is super powerful. So I think, look, at some point, whether it's this year, next year, the year after, we're going to start to get, housing activity to, create again. And even if it doesn't, they're still growing mid-teens in that environment. And the rental business, the mortgage business are all doing well. As time goes on, that those higher mortgage rates become the norm. And I think that's important because you all of a sudden have a baseline versus 5-10 years ago as time goes on. Airbnb, I'll be quick there, but Airbnb again, I think they just saw a reacceleration in growth here. You have a lot of big events this year, so I think there's like a natural catalyst in the near term, but also long term. I'm actually utilizing, and I hear from different people in different surveys, their experience tab, which they've been trying to do for the last like
Yep.
6-7 years, is actually starting to like resonate. They made a on their earnings call, they threw out a stat which I found interesting. I think they said 50% of all of their experienced users actually weren't people on there that booked a home during that time. So people were coming to Airbnb to source experiences as opposed to a home, and then they own Hotel Tonight as well. So I think hotel, your kind of like extended stay slash shared ecosystem, and then you have this experience economy. And then again, you take the idea that vibe coding and the ability to spin up new potential products faster than ever, I think serves the incumbents better to build and fill out their super app desires. So that's a long-winded way of saying, we like all three.
Okay, so it sounds like Airbnb, more travel, Zillow, housing, but less about being bullish on housing volume and more this is the future of where the housing market is going. I mean, what catalysts are you looking for to see overall housing market volume start to pick up? Is it purely rates? Are we waiting just for rates to turn around?
Well, we were getting it, right? We were starting to get it in the last like 6 months before about a month ago. So we were starting to get that activity. It was starting to pick up. We were starting to get rates, sub, right around 5.5% on the 30-year, mortgage, that is. And so you were starting to see, the 10-year and the 30-year mortgage start to compress in terms of spread, but also in absolute terms in both. And so that was starting to fuel some excitement in the housing space. There's nothing you can do in terms of like some of that getting blunted by the war conversation, which, if people are saying inflation plus economic potential risk, people bucket that as stagflation, whatever they want to call it. That's never a good signal for somebody that is looking at mortgage rates as the catalyst to fuel housing. So both of those, can't be right. And so, that was the catalyst. And I think, again, maybe it delays it by, 6 months or something like that. So again, taking that long-term hat on, we think that was the catalyst. That is the catalyst, and that'll remain the catalyst going forward. Outside of that, what can they control is, again, their ability to continue to bring on new rental categories. That's growing 33%, right? So like, the rentals business is humming along. And so you have this like product capability that's already doing well, meaning organic, self-created growth. And so that would just be the cherry on the top. Now, the market provides valuations based on the here and now, as opposed to, where we are, 5 years from now. And so, in moments of scare, I think, those valuations compress, and that's totally normal. But net, the fundamentals of that business, and again, they just spoke here, in the last couple of days, and they increased their forward targets on margin. And so a lot of that for us makes a lot of sense, and it's just a moment in time. And ultimately, the new catalyst would be when this war ends and oil prices and the fears of stagflation start to subside. That would be the new catalyst to then get the old catalyst back in line.
All right. Well, I want to close with one final question about valuations compressing, and let's fast forward a few months from now and say, the war has dragged on longer than people expected. We've got oil north of $100. People are concerned about inflation. They're concerned about demand falling off a cliff, and the potential for inflation to turn into a more recessionary environment. What are the areas of the market that you think are a little bit too expensive right now, that if we were to get that environment where multiples start to compress a little bit, you're going to be shopping around and buying?
Look, I think everyone's kind of been waiting for the break moment in some of these AI names. We're big believers in the second time around for transformative things. You go back to the early '90s. You could have been very right on Cisco, but if you invested when everything felt perfect, it took you 25 years to make money. And you finally made money for the first time buying somewhere around those 2000 levels for Cisco last year. That was the first time you made money in that time frame. And what you actually found was, waiting a year or two post this transformative moment is actually, tends to be more constructive. And again, 2000 is just one example. There's other examples beyond that, whether it's, what happened in mobile, what happened in social, what happened in cloud. That second time around thought, I think, is you definitely have the ability to see who is actually winning. And right now, you look at someone like Nvidia or AMD, and then you hear, ARM, trying to create their own, CPU chips. You have, Meta, obviously, trying to build stuff in house. You have Google with, their chips. You have Amazon with Trainium, and then you have Microsoft, likely creating their own stuff as well. And so I don't think it's as clear, but as time goes on and valuations compress, I know valuation multiples on Nvidia and some of those look appealing at first glance on a PE multiple basis. I think part of that has to do with some investors, a lot of investors, starting to look at the other side of this, which is how long is the duration of these buying periods, and kind of like what is that refresh cycle going to look like? Is it 3 years? Is it 6 years? And that changes the dynamics a lot. But look, there's a lot of that ecosystem that we think could be attractive at the right prices with the right margin of safety. But we're not going to go head first trying to hope either one, just ride a trade and hoping that we're not at the top of the trade. That's just not what we do. And then two is we'll have clear skies of like who's actually winning. And look, you're going to see OpenAI and Anthropic probably go public. Either one of them this year. You have SpaceX too. A lot of liquidity is going to hit the market for that. And so, I would say those are some of the areas that are interesting. For the most part, from a valuation perspective.
Is that SpaceX IPO going to be the big bell at the top of the market?
Man, and this thing could come out at, yeah, it's gonna be tough, right? Because like,
How do you even
if anything we've learned, right, Musk is really darn good at keeping a valuation elevated. And so he just got in trouble for his tweets from years ago, but um, he's multiple tweets away from propping that any asset back up, right?
Well, if the mini, I mean, I'm sure you followed what happened with VCX, the Fundrise growth tech fund
Yeah,
that came out at, I think it was like a $20 NAV, and it was up over $500. It's come down quite a bit, but certainly there is demand for these speculative companies, these companies that are giving people exposure to these AI trends. So if there's $1.5 trillion of demand, I'm not sure, but it remains to be seen.
for sure. But also think about the circular side of that. If Anthropic and OpenAI can raise a ton of money, what does that do to the semiconductor infrastructure trade? Right. That's also it just reinforces it more because now they have. I mean, talks are what $75 billion raises, $100 billion raises. I mean that buys you three large scale data centers, campuses. That only fuels the AI infrastructure trade, likely more, or at least holds it. And so it's hard to look at that and then call it a top because it does reinforce some of the stuff that's been working. But again, nobody knows if that's going to be the top, but it's surely going to be a lot of capital that's going to be required to flow into them prior. And I'm assuming they'll have it ready from sovereign wealth funds and all this other stuff that will be out there ready to have their stake in the game.
All right, we'll leave it right there, Sean. Where can people find out more about you and follow you?
on LinkedIn and Twitter, I post a lot. At underscore Sean David is on Twitter, and then Sean Emory is on LinkedIn, and we have a YouTube channel. We post some stuff there randomly, but Max does a better job than we do on that stuff. So that's kind of
Yeah,
where you
you
can
have a
find us.
podcast. Come on, plug the pod.
Yeah, look, we have Around the Desk, Avery Around the Desk. On Fridays, we put out videos where we articulate, what's happening in the world. And, they're 10, 15 minutes in length, and, they're data driven. We're definitely a data driven firm. And we're going to, this week we have ours. Next week, we're ringing the bell next week. So that'll be fun. And yeah, so anyways, that's where you can find some of our work, and the podcast, Avery Around the Desk, is a good one. We bring on guests of all types. Maybe we'll have Max on and get the other way around here.
All right, that sounds fun. Well, yeah, go follow wherever you get your podcasts Around the Desk, like, share, subscribe, and the same thing for Other People's Money. Thank you very much for being here, Sean, and thank you to everyone for listening.
Awesome, Max. Thanks for having me, man.
Interested in learning more about the Pictet AI Enhanced International Equity ETF, ticker PQNT, or the Pictet AI Enhanced US Equity ETF, ticker PQUS? Click the link in the description to learn more.